Okay, great. I think, and I hope first, I'm just gonna say this after all the panels, it's 5:45, so I hope you guys are still all awake and still with us. I know some of you are looking forward for some drinks afterwards, so that's always a challenge. But nevertheless, I hope this very last panel was today we have, or maybe there's one after, I'm not sure. At the very least, we hope we prepared actually a very good, we prepare a bit of good points and discussions, bringing you some probably different perspectives compared to what you've heard a bit earlier in the day, really from what we are called as traditional financial institution, but also a bit of mix of digital and hedge fund, digital native funds, I'd say. So a bit of mix will give us that flavor. But what I want to say is really, first, welcome you all, welcome the panelists. Maybe before I start, my name is Mohammed Zarakit. I'll be moderating this panel, which will specifically focus on, as the title says, unlocking institutional DeFi, but this is really more about the adoption side of things, the risks, the challenges, and the benefits, and where are we. I'm delighted to be having from some left side in there, Tim, a hedge fund manager, Dotan, he's from London Stock Exchange, and Iota from OECD, an economist in there. I'm not going to give you the mic to introduce yourselves, otherwise it's going to be a bit long, but what we want to really cover is a couple of these points and then open the floor for questions, so please prepare those because you will see you have a great panelists that are vocal on this topic and very well informed. Welcome. So maybe...
To you as well, sir.
Thank you. So maybe just to kick this off, and I'll start with you, Tim, given that you've actually won, that's good, I can say that, right?
Yeah. It'll be the third award.
The best performing hedge fund manager in crypto last year, and he's getting an award.
No, not in crypto.
No?
The best performing hedge fund manager in 2021, period. The word crypto doesn't appear in that sense.
Even better. So,
but it was all done through crypto, believe me. Kick fiat's ass every time.
Yeah. So, of course, you deserve a clap in there, and the award is coming. But maybe to bring it to crypto, especially to DeFi, we've seen a few years ago, at least the space is growing. Mostly initially started retail, but started also later, we start to see institution coming in. So why the adoption is coming in there? And importantly, what is driving this growth from institution? And a little bit more about the benefit for them.
Remember the movie Wall Street? Michael Douglas, right? Greed. That's what's driving it. Look, until very, very recently, until interest rates started increasing, there was no yield to be found. The nice thing, the biggest attraction for institutions into DeFi, and by the way, listen to that sentence, institutions into DeFi. So you're talking centralized financial institutions going into decentralized finance. The very question is a tautology at best and an oxymoron at worst. So it's a search for yield. And everyone's afraid of trading in crypto. And even in my fund, I've got a number of classes. And we're starting to move more into what we call QFI, quasi-fixed income. Because trading's hard. And you can lose your shirt trading. Of course, if you're Celsius, you can lose your shirt doing DeFi as well. But that's because you're leveraging and you're doing other things that are too risky. The reason institutions are interested in DeFi is purely, simply a search for yield at a reasonable risk. Now, that second half of the equation is a whole nother discussion.
I like that. And maybe I'll bring Iota into this. First, do you agree with what Tim is saying? Two, what are the other things maybe bringing institution to the space?
So it's true. I agree with Tim on the search for yield, for sure. I would add to that it has been very much hyped, that there has been a lot of recycling of profits from mainstream crypto activity, like just holding Bitcoin, into the DeFi space. And of course, this is one of the reasons actually we saw the explosion in total value locked in DeFi, because this is there are feedback loops between mainstream crypto market valuation and the DeFi market explosion. But I would add to the search for yield the search for unrestricted leverage. Even for the likes of family offices and hedge funds and high net worth individuals as well, it has been one of the main drivers into this space. And we should not be ashamed of actually stating it, right, Tim?
And leverage is just more yield, right? At the end of the day.
So maybe I'll just stay with you for a second, Iota. From the research you've done until now, and of course maybe you guys can also add to that, what is the percentage, if you want to say, is already from institutions has been coming to the DeFi space versus at least the retail?
So it's very difficult to quantify the percentages because, of course, everything is happening in a pseudonymous way. So there is no actual link of users to either geography or type of investor, and most of this evidence is qualitative, at least in our analysis at the OECD. One thing we've done, though, is that to add a bit more color to the qualitative analysis we've done, was to take as a proxy of participation in DeFi the size of transactions. And then if we consider that any kind of transaction that is above 1 million is considered professional, if not institutional, then we end up with more than 2/3 of participation being done by professionals and institutionals, which is exactly the opposite of what DeFi was intended for, at least in terms of what people were advocating about democratization of finance and promoting financial inclusion. What we saw actually was a lot of unrestricted leverage and a lot of professional and institutional, such as family offices and hedge funds, using this kind of next level of financial engineering to find yield.
The interesting thing would be what percentage is what you're calling professional and institutional, right? Because there's so many whales now in the crypto space. I would guess that a very large percentage of that dual category is professional, and a small portion of it, 10%, 15%, is what most people would think of as institutions. But I'm guessing, right? Because as you say, there is no quantitative data, it's all qualitative.
Right, I'll come back to the CeFi and the DeFi portion of things later, but maybe before we move in there, I just want to bring Dot into the conversation. From where you sit at the LSE, just want to say there's a bit of demand we know in the markets coming, maybe for institutional product or things to come. Wondering what you're hearing from your clients, number one, and what are you doing at the LSE in this space?
Yeah, I'm happy to answer. I think just to touch on the last point as well, though, and I think it's an important qualifier because I think a lot of the time we talk about institutional adoption of DeFi and institutional adoption of crypto, but we need to be careful about what we mean by that, right? So when we say institution, there are different types of institutional players, and largely the majority of them that are in this space today are your hedge funds, your family offices, your prop shops. You won't tend to see a proliferation of large IBs or heavily regulated financial institutions in the DeFi space today for a number of reasons, not least of which being many of these organizations obviously have close relationships with regulators, and there is a lack of regulatory clarity around how they're looking at DeFi as a space. Obviously that's evolving, and there's, that needs to move forward, but there are real questions around how regulators get there. I mean, ultimately, when you look at principally the activities that are being performed, and a lot of regulators like to position themselves in that seat where they say, look, we regulate based on the view that if it's the same activity and the same risk, we will ensure that we put the same rules in place. But the question then becomes, if you were to take that approach to DeFi as it exists today, suddenly most of these protocols, as we see them, they're providing multilateral access to trading and settlement, they're providing a measure of price formation. Suddenly it looks like an MTF, right? Suddenly it looks like an exchange. And you can't then just blanket apply the same rules because you need to have a central operator, you need to have obligations against that operator. There's a big liability question that DeFi today does not have an answer to. So again, taking a step back to kind of how we see things and some of the conversations that we're having with our customers, obviously this needs to evolve. There's a lot of exploration around, can we take, let's say, inspiration from the DeFi markets as they exist today, but use that as a lens to propose new solutions in the regulated markets, in the in capital markets. But again, there are lots of questions there around how you actually realize that. There are potential avenues to take that forward when we look at some of the work that the EU Commission has done in the pilot regime, and equally, in many jurisdictions they're looking to roll out similar frameworks to be able to evolve regulation and policy to accommodate these types of models. I know the SEC recently put out an announcement to effectively augment the definition of an ATS so that they could start to bring into the perimeter some of these DeFi models in the long term. But I think, again, this is going to be a journey, right? And the fundamental questions to answer are really ones around liability. Who controls this protocol? Who provides this service to the market?
Yeah, and that in itself is a big question to be answered anyways, that we were talking about it from multiple perspectives, not just in the DeFi. You've touched a little bit on the challenges, and of course regulation is one of them. But maybe let me come to Tim and then you, Iota, and of course you Dotan, to elaborate a bit more. Of course, all these new applications, whether it's from the retail side, but also in the institutions, create a lot of new challenges and risks as well. So can you maybe highlight a bit to the audience, what are the major ones? And then importantly, how can we navigate that?
Well, there's one thing I think that people forget about, particularly at conventions like this, right? And that is crypto is tiny, right? People like to say, oh, crypto market cap was $3 trillion. It's as big as the economy of, well, let's see, if it's $3 trillion, it's going to be like France, right? Or California, which is number 5 in the world. But that's a completely false equivalence because you're taking market cap to annual gross domestic product, right? Which is being churned over every year. The crypto market is so fractured, even with BTC having 43% dominance. It's very, very small on the daily trading basis. So I would submit, in addition to all the points you made, Dotan, that regulatorily it's a nightmare at the moment. But there are regulatory exits for non-material investments. And that's where every major institution can be now, but they can only put their big toe in the pool because the pool isn't big enough for their entire foot, much less for them to dive in. It's a tiny, tiny, tiny market, which means there's no liquidity. You want to get out quickly? Look at the Terra Luna issue. Look at what's happening to Celsius. You can't move a large amount of money, and it's not even that large, right? We're talking less than $1 billion. You can't move it quickly in this space. Big institutions, they want to be able to unload large amounts of assets on a short period of time and pick them up in a short period of time. Guess what? In crypto, you can't. So the institutions that are in crypto right now are exactly what we've been talking about. They're smaller institutions, whether they be prop shops or very forward-looking family offices or hedge funds like mine. That is the closest you're getting institution. You don't see large, retirement funds. You don't see the Norwegian fund. You don't see CalPERS in the US. You don't see big sovereign investment funds diving in a major way into crypto. You can't. There's just literally no room for them. And DeFi is a relatively small subset of that. Yes, there's some good turnover, but it's split among all sorts of decentralized exchanges. So until the overall space gets a lot bigger, you won't see the big gorillas, the global gorillas come in. Frankly, I kind of like that, but big institutions are not going to be in DeFi or in a crypto for that matter anytime soon in a significant way. They can't.
Yeah, and when I'm often asked, our institution in the space, I say, which institutions we're talking about? Because if you put it the way we define institutions, it's a completely different way than...
The most interesting institution that's going in this space right now is Goldman Sachs, that's putting together a $2 million fund that I'm trying to get into to buy Celsius assets on the cheap. Why? Because it's $2 billion. Because what has Celsius done? It's been a big aggregator. It's collected a whole bunch of assets together. It's done all this work over the years. They screwed it up completely because they way over leveraged and under collateralized no matter what propaganda they're putting out there. And so now you have this beautiful holy grail. We can put in 9, 10 figures into this sector. Let's do it. And it's already diversified because Celsius has collected it all for us. Very exceptional, and that's a huge move. You got Goldman Sachs going in with $1 billion. Something's happening. So we're just starting, and that's literally the first step.
Can I just add something? I tend to disagree a bit on what is the reason large institutionals, the conservative, traditional ones, are not into this space yet. I don't think it's because there is lack of liquidity. Of course, this is one of the reasons, but not the primary reason. The primary reason is that which of the pension funds that you cited would allow themselves to get into a space where there is provision of financial services in a possibly non-compliant manner, right?
You would be amazed how many of those big institutions and pension funds have approached my fund, especially after we got these awards, to set up a share class for them that would have, say, 50 million, 100 million, which is peanuts for them, right? It's less than 1%. They want to understand it, and they want to put their big toe in it. And to your point, because I'm a hedge fund, they've got enough of a shield there, right? All the garbage I'm dealing with myself, they don't have to deal with. So it's clearly an effect of it. But even if they wanted to, there's no room in the pool.
So compliance, liquidity, workaround solutions, size. What else from you?
So I can't speak on behalf of the industry, although I did just mention something, just to make the point with Tim, just for the sake of
keep going, Iota. Keep going. Keep going.
But I would say that from the broader high-level perspective, there are some issues that may impede the growth of institutional DeFi at the current stage and at the current form of DeFi as it is. And a lot of it has to do with some of the design characteristics, for example, some weaknesses in governance, as what we have witnessed with Terra or with other recent failures, the fact that there can be market manipulation, or the huge potential room for exploits and hacks. And of course, somebody will say, but we have market manipulation in traditional equity markets as well. But the thing is that in DeFi, because of the weight that smart contracts have in the operation of DeFi, because of the weight of automation for those protocols to work, there is much more room for this kind of exploits. And the second very important fact is that there is absolutely no recourse for the investor, and this is huge, hugely problematic. And the other thing is that there is no actual resolution scheme or any kind of this kind of winding down, and that's what we saw in the recent failures as well. All these things make it a bit more problematic for the traditional institutionals to get into this and for institutional DeFi to grow in a meaningful scale.
Yeah, so quite a bit of problems been mentioned, but then what is the solution for that? Maybe, Dotun, if you can mention a few of your thoughts when it comes around the mitigants at the very least.
Fix the problems, Dotun, fix the problems.
I mean, I think largely, it is a tough nut to crack, and I think we've touched on a couple of areas that I think, is kind of how this space may potentially evolve. I mean, I know, we've seen players in the space that have looked at sort of developing and deploying regulated DeFi protocols. So, I mean, Aave have their kind of whitelisting sort of venue, and there are others that are looking to kind of provide similar services. But I think it will be an incremental evolution of the markets and maturation of the markets fundamentally. There's so many different considerations around, I think, Yota's point around investor protection, right, that need to be established and put in place. And either you're conforming to existing rule sets that exist in the capital markets today, or you're trying to define analogies within this new space such that you can then helpfully steer the regulators towards a new framework that is more amenable. But either way, these are the types of considerations. You're looking at kind of systemic risk and overexposure to the volatile instruments that underlie much of these activities, and thinking about how you start to plug some of those gaps fundamentally. But it will be a slow burn, and it will take a lot of participation across the board, both from sort of CeFi and DeFi players, I think.
I'm not a crypto maximalist, but I don't think all the problems that Iota listed are problems. Okay? First of all, transactions being irrevocable. I don't see that as problematic. right? You have to deal with the rules. You know the rules. Send some dust, adopt something. There are all sorts of mechanisms other than making a transaction revocable. And just to sort of make a point, I also don't think that having a bailout scheme is necessarily problematic, right? So letting a Lehman Brothers collapse may have been a better, faster way out of the 08-09 crisis. I'm not saying that's true, and I'm not saying I necessarily think quantitative easing was a bad move, but just look at the sheer fabrication out of nothing of fiat that took place during that. And that was, QE is one of the reasons why crypto has attracted so much attention. I would also take issue with the fact that there's no recourse. Now, here's the controversial one is, of course, Solend, right? Because Solend comes out, you've got 80% of the market cap that's controlled by a whale, and everyone votes through a DAO-like mechanism to deprive that whale of all of his rights, sell some of them, and then give the rest of them back. And then the next day they reverse that, and then ultimately this whale takes 20% of the assets out of Solend. So clumsy as hell, awkward as hell, looks ugly, but it's another path. It's another path to figure out, okay, if we're going to go to decentralization and the sometimes chaotic effort of that. On the other hand, it's very, very democratic. But do you want to deprive rights? You have dictatorship of the majority and all these other things. But the only answer is not how these issues are addressed in the fiat space today. So Doten, you are correctly saying, hey, is it going to converge into current regulation, or is it going to be a new paradigm? My deepest hope is that it will be a new paradigm, because the only way to solve matters is not how they're being solved in the fiat space today.
Just one quick reaction, because Tim is provoking me.
We're
quickly.
gonna
So-
be the referees.
It's all Doten's fault.
So just one very quick reaction. You mentioned Lehman when we talk about resolution. I will mention Terra and how some of the big players and some of the whales or the just powerful participants got out in time and at good valuations when all the retail participants got away with zero. If you
That's a
think
pretty big generalization, but keep going.
if you think that this is preferable to having some sort of resolution mechanism that provides some path to a fairer system, then okay.
Yeah, but your characterization is pretty black and white, Iota. You know it's not completely the case.
There's actually evidence of this having
But
happened.
you're saying all the institutions got out and all the retail guys got
No,
killed.
there have been, okay, let me rephrase it. There have been certain whales and important participants who got out early, and
No,
many retail investors
I agree it
who got
wasn't
away with
fair.
zero,
I
so-
agree it wasn't fair. But I also said it's not, even what happened with like Solend, for instance. The crypto space is groping its way to some sort of governance. And my only conclusion is the unique solution is not to try to govern crypto like fiat is governed. If nothing else, the transborder aspects of it will make that impossible.
Yeah, and those are all great points. I think we can continue that piece of discussion outside over a drink or few.
Or boxing gloves.
But I'd like to get to the next question.
Tim is buying drinks.
Yeah, voila. I'd like to get to the next question just before opening the floor to a couple of questions. So maybe with you, Doten, given there was a bit of, you've been excluded from that conversation between the two. So just bringing some of the chat to what we started a bit earlier on the CeFi and DeFi. So DeFi was supposedly, as initially been indicated, to be decentralized for everybody, all the things that mentioned, but then slowly we start to see more and more conversion, if you want to call it, or even interlinks that's happening. So just wondering on that point, how decentralized finance is, how much decentralized finance is decentralized, and how much actually interlink is taking place between the two, and as such what it means for risks as well as benefits for the space.
It's a good question. I mean, I can't talk to how centralized is decentralized finance in the sense that, I don't have that level of visibility. But I mean, I think clearly, we're seeing relationships driven, whether systematically or through intermediation, between, asset holdings across different venues. And, that may be driven by portfolio, it may be driven by other factors. But I think that the key consideration here is, that is pure decentralization always, the necessary evil that we all need to strive towards? And I think that in itself conceptually needs to be challenged. I mean, I think in the last conversation, one of the presenters made the point around, sometimes intermediation and centralization of a specific function is necessary. You do need convenience. You need someone to be able to abstract complexity. And I think that's relevant in all sorts of contexts. So I think, with all of this, we talked about a lot of the risks that we see in the decentralized finance space today, and these are some of the major challenges that we see in having large-scale institutions participate within this market. I think, at least through a practical lens and short-term, how do we see, companies really getting through that and overcoming some of the challenges? It has to be through trusted relationships with professionals, fintechs that are closer to the space, that have much more of a specialism in that area, and who can largely manage a lot of those risks in a very narrow context. And over time, that builds trust, that builds kind of, a greater amount of capital that then gets deployed into that space, where incrementally one can solve for some of those challenges. But really, the key in all of this is just making sure that, there are those protections in place to maintain stability of the markets, to protect investors fundamentally, and to maintain the stability of sovereign economies, which is really at the heart and soul of what large-scale institutional finance and regulation is really trying to achieve.
And maybe I thought that based on what Doton just mentioned, what is it like maybe the number one factor we would want to see maybe better off or happening for institutional, the big institutional players come to eventually to the DeFi space?
In terms of factors that we have not mentioned until now in the discussion, I think that the KYC and the AML CFT controls are perhaps the elephant in the room. There is absolutely no way that institutional DeFi can grow without having some sort of customer due diligence done for the institutional investors. And this is where Doton mentioned those institutional versions of some of the most successful DeFi lending protocols coming out. Now, in terms of your point about interconnectedness and linkages between DeFi and the traditional centralized financial institutions, at the OECD, we came out with a report of the Committee on Financial Markets on February about why DeFi matters. And then in April, we came out with a second report about the institutionalization of crypto and how there is potential for growing interconnectedness between DeFi and TradFi. And the main linkage that we have identified is the use of stablecoins. Stablecoins being the foundational basis of many DeFi protocols because of their multiple uses and allowing and enabling the growth of these systems, while at the same time, for many of them, the non-algorithmic ones, the fact that they are backed by reserves that are financial products, financial assets, are actually linking directly these kind of markets to the traditional markets. And the point we made is particularly around commercial paper markets, given the reported reserves of Tether, for example. And what we saw later with the UST failure is that even though UST was an algorithmic one, so we did not have this kind of risk of reserve assets being linked to the traditional markets, we did see Tether as well depegging and having 7 billion of redemptions in one day. And this kind of confidence and lack of confidence spill over to other parts of the DeFi system, which then can spill over to traditional markets. So this is one of the main concerns that we've raised, and we actually saw it materializing with the Terra.
Yeah, absolutely. And I think this very last point in itself is a whole panel to be, if we want to dig deeper into that. But maybe just conscious of time, I'd just like to open the floor to some questions if there are any in there, or otherwise we can have a few more questions.
Hi, it's been really interesting to hear you out and hear what you have said. I have a question here with the institutional DeFi protocols and the investment of these institutions, because you've been talking about how it's the market is not big enough for some institutions, but it's big enough for like a hedge funds and family offices. And what's the risk management that you have in mind when you are trying to drag a family office or an institution into this DeFi market? Because as long as you have good yields, you have double-digit yields, you have also volatility. So you cannot promise like a kind of stable output there. So what's your managing idea of these risks? And I see you smiling. So
Well, we're actually launching something in the US in a couple weeks called Variable Alternative Inflation Resistant Interests. Standard hedge fund based in the US where the regulatory environment can be a little bit difficult. It's going to offer US CPI plus 2% or 5%, whichever is greater, annually. Because from a DeFi perspective, we are offering another product where we do an 80-20 split on DeFi yields. And over the last 12 months, it's averaging 30% in an 80-20 split, 30% to investors. Investors are scared of a 30% yield. It's a Ponzi scheme. It's a pyramid scheme. It's something. There's something wrong with it. So instead, we said, okay, fine. We will give you the latest buzzword, inflation plus. You don't have to worry about it. And we're going to do the same damn thing in the back office we're doing to give you 30%. Only we're going to keep everything that's above inflation plus 2. And today it's like running 11%, so we're not making a lot, right? But we're making something. And as soon as this crypto mini ice age is over, the yields will go back up, probably not to where they were before, which the race to the bottom on yields is a whole nother topic. But we're offering a semi-fixed, if you will, yield in the front and doing DeFi in the back, and we're taking that risk. But we're also creating a reserve equal to 18% of AUM so we can cover any down periods. So that's how we're offering it, and people are just insanely enthusiastic about this product. They're scared to death of DeFi, and this is a way to let them kind of get close to the flame without getting burned by the flame. Does that answer your question?
Is there any other question maybe there? Okay. Well,
Can I
anyways,
mention perhaps one
sure.
less dramatic way to help institutional DeFi is perhaps the use of tokenized regulated assets instead of crypto as collateral, and basically use DeFi as the venue where we can repo this kind of tokenized securities in a compliant manner, and making deriving value of the efficiencies of DeFi and of everything, all the potential benefits that the system can give us, while maintaining a more compliant participation in this kind of systems. This could be perhaps one other avenue. And in France, the arm of Société Générale that looks into innovative technologies, which is called Forge, has already a pilot with Maker about this kind of mechanism.
Yeah, absolutely, and we've seen what Forge has been doing in this space for a bit. So maybe if there's no other question, I'll take one more in here. Just in terms of where do you see the space in the next few years? I mean, you mentioned a few things, but how at least you would like to see the space come as things changes and regulation comes and so on. What are the few things you would like to see to eventually get up in that?
I don't know that I want to see it, but what we're going to see and what we're already seeing is a race to the bottom. Yields are too good, yields are too high, and money, more and more money piles in, and that means the yields are going to go down. Interestingly, there's a very definite silver lining to the UST crisis. there's a very definite silver lining to what's the problems with Celsius and Three Arrows. And that is that the runway for high yields in the crypto space has gotten longer. So many people are afraid of the space now. The race to the bottom, last year I would say we have two to 3 years of good yields, and then we're not going to get down to fiat yields, but we're getting in that ballpark. The perception of risk is higher, so we're not going to drive the returns all the way down. But it's now still 2, 3, or maybe 4 years because everyone's so afraid of this space. So for people who know how to deal with DeFi, for people who know how to select protocols, you actually have a longer runway today than you had a month ago. I don't know whether it's a good thing or a bad thing, but that's definitely what's going to happen, and you can see it already.
That's what a hedge fund manager would tell us. Do you have the same opinion, or you would defer?
No comment. No, I mean, I think absolutely. One of the things I'd like to see, I think, is again, it's been touched on already in the conversation. It's looking at, how can this space mature to the extent that, we can get real regulatory clarity, right, around establishing, regimes that can provide for those protections over the market overall, but at the same time allow the kind of innovation to continue to flourish and evolve. So it will take time, but I think it will take broad participation across the board from both the regulators and market players, and I think we all need to kind of strive in that direction. So, yeah.
I totally agree with what Dotun has just said. The term I like to use for the future is a symbiotic relationship between DeFi and TradFi because it's beneficial for both. So if we don't get the big financial institutions and the pension funds and all the more conservative institutional investors into DeFi, DeFi will never really grow sufficiently to be meaningful. And at the same time, there is a lot of potential efficiencies and potential benefits for those traditional financial institutions. So a symbiotic relationship is what I see happening. Now, the interesting thing that Dotun mentioned is the multi-stakeholder dialogue, which has to be one of the priorities for the industry and the policymaking community, and that's something we strive for at the OECD. And what is also very important to note is that there needs to be cross-border coordination, because if we have champion countries, champion jurisdictions, and then others that do nothing, it's not going to be beneficial for anyone to just see people doing regulatory arbitrage and moving from one jurisdiction to the other. So international and cross-border coordination will also be crucial to achieve a better outcome.
Hey, I like regulatory arbitrage. What are you talking about? One thing I have to say, though, before we finish is the most remarkable thing about DeFi you can see in the profiles of the four of us up here. I'm just a damn crypto capitalist, right? I've been doing this. I launched the first trading fund in the crypto space in 2013. But look at the rest of these guys, right? We got Bank of New York Mellon over here, right? So a very much classic blue chip, nose in the air, hoity-toity financial institution that goes back more than 100 years. I knew Mellon, by the way, before he died of his latest drug overdose.
I don't know if that's how our marketing team would like to say.
Fortunately, your marketing team did not talk to me before. And then you have the Organization for Economic Cooperation and Development, right? You've got a representative of all the rich countries sitting right here talking about DeFi. Right? Which is in and of itself is remarkable. And she and I very friendly disagree on almost everything. It's absolutely great. I love IOTA. And then you have Dotun here, the London Stock Exchange. What the hell is the LSE doing here talking about DeFi? Right? The makeup of this panel and the fact that these institutions felt that it was relevant, that it was worthwhile to send some rep here to talk about DeFi to a bunch of other crypto crazies. That in and of itself is a remarkable development in DeFi.
That is in itself a remarkable development, absolutely. But eventually, to your point and your point, adoption will only happen when everybody's converging and coming together. It's not just once, probably a community.
Okay, I'm not singing Kumbaya with you, Mo. There's no way.
We'll talk about it later over at drink, but I think we really ran out of time in here. I'd just like to thank you for this entertaining but also enriching discussion. I hope you guys have enjoyed it. If you have any questions, please reach out to everybody.
Thank you all.
Thank you all.